Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I appreciate your tuning into the show. We've been doing a series of life insurance programming needs, life insurance planning for families, individuals, and business owners alike. So we have a special guest with us, Ian George. I appreciate your coming back on the show.
Pleasure to be here.
We're doing a series on the life insurance and the stages in planning, let's say. So if you've missed any of the prior shows that Ian's been on, the most recent 3 shows, you can go back and tune into those or contact our office and we'll get you copies or give you access to those shows. What we left off with last time where we touched on different types of and forms of life insurance. So what we wanted to pick up today was really going and expanding in on some of those forms of life insurance. So if you don't mind, I'll turn it over to you.
Fair enough. When last we spoke, we were talking about the different types of coverages, and we really delved into how they work and what they're used for. And what I thought would be a good progression of that today would be to discuss what you can do in the living benefits and different areas that those touch on in regards to a whole life insurance contract, which I thought would be a good place to start. Now, these benefits exist also in different types of permanent life insurance, such as traditional universal life insurance, as well as the index universal life insurance and variable universal life insurance, all those universal life contracts. Those contracts have these features to certain degrees as well that we can touch on another time as well. But today, for the simple focus, I thought we would talk about how whole life insurance works. So, one of the advantages on the living benefit side of a whole life insurance contract is obviously the cash value that accumulates within those contracts. The contracts, as they're growing in cash value, tend to offer more and more riders each and every day. One of the riders that has become rather popular is a long-term care access rider. And a long-term care access rider basically states that an insured can use 90% of their death benefit for long-term care coverage. So if you have somebody who owns a whole life insurance policy for, $100,000, they have automatically from day one $90,000 that can be used for long-term care insurance.
Are some companies different, only limiting it to different levels?
Yes, and actually sometimes not only do the companies don't necessarily limit the levels that people can get. 90 is about the average. Okay. Although insureds, if they would choose to, that being, the client, if they like, they may want to limit the amount of coverage that can be used for long-term care.
Okay.
So they could cut that down to 50% or a certain amount. So the advantage to this is that the idea that came up when all of this started was we have people who are looking to to build programs for long periods of protection. I want to make sure that I have a life insurance benefit that can be used by my family forever. Well, add to that sometimes there's one more risk. And the last risk that often people, that most people will face in retirement is the risk of the need for long-term care. It's like the last outstanding, risk that people have a hard time putting an actual number to. We just don't know. We don't know if we'll need it. We don't know how much it will cost. We don't know how it'll be taken care of. So anytime someone's given an opportunity to protect themselves against that risk in another fashion, that's where this can come into play. The big key on this is that you now have your components of a life insurance policy and a whole life insurance contract. Of your benefits now consist of the cash value, which is the equity that you have in your policy. That is liquid. You can call on that and you can use that however you see fit. That doesn't have to be for long-term care. It could be for a vacation. It could be for anything. You just want the cash, you can call the cash out. So that's your bucket of equity that you have within your whole life insurance contract. Obviously, then you also have your death benefit. Something happens to you upon your death, that's what your beneficiaries receive. Okay, and as we had discussed before, if you've borrowed money from your cash value or pulled money out of your cash value, it's your death benefit less the amount of cash value that you've taken already is what your heirs would get. So the way I've often described the cash value of a whole life insurance contract is to say the cash value is an advance on the death benefit.
Okay.
So with a dividend paying whole life insurance contract, what you have is that your cash values in your whole life insurance, your death benefit, are growing over time. As long as the carrier that you have is paying dividends, those cash values and those death benefits are continuing to grow. Okay. Dividends aren't guaranteed, but the vast majority of mutual companies have paid a dividend virtually every year of their existence.
Okay.
So you don't know by how much they're going to grow, but they're probably going to grow. So you add to that now the long-term care access rider. Now the long-term care access rider basically says, I can have 90% of that death benefit. Now again, you have your choice of how you want to, you could have it be of the base death benefit, or you could have that be 90% of the full death benefit, including the dividends that have grown that death benefit. So now you have essentially three areas of when you're looking at a policy. I have my cash value as my living benefit. I have 90% of my death benefit as a long-term care benefit, and then I have the death benefit. Now, of course, if you were to use all 90% of your death benefit for long-term care, your heirs would be left with 10% of your death benefit.
Okay.
But what it has come to show is, and this is the interesting thing about these types of riders is, they're not really designed to eliminate the need or desire to look into full long-term care coverage. What it really is a way to account for something or to give yourself some extra protection. So people who have taken a look at what long-term care insurance could cost, even in the example I just gave, a $90,000 lifetime limit on a long-term care contract, that's not going to be a lot of long-term care.
Right.
Different,
not at today's expenses.
Right. Different models would have that covering you anywhere from, a year to 2 years in terms of what would go on. However, what a lot of people do like about it is it's an added piece of protection that they can have. It's not that I necessarily want to do that, but while I'm setting up this policy, here's another way I could add protection to another area of my life. So those contracts have become more and more popular. The other types of contracts that people do that with are the guaranteed universal life insurance contracts. Now, the guaranteed universal life contract, for those of you who don't keep all this information straightforward and right in front of you at all times, that's basically a contract where your premium is guaranteed and your death benefit is guaranteed. So no matter how long you keep that life insurance policy, your premium will be the same. And no matter how long you keep that life insurance policy, your death benefit will be the same. There probably won't be much of any cash value that accumulates within that policy. And as a matter of fact, to keep the guarantees, you're not allowed to touch the cash value. So, but you can put a long-term care access rider on a lot of those contracts.
Okay.
So now I have, with a guaranteed UL, I have the guaranteed premium, I have my guaranteed death benefit, but I also have access to 90%, and in some cases with those contracts, up to 100% of that death benefit available for long-term care.
Okay.
So these are different ways that these benefits are being used as part of a living benefits plan or living benefits and additional insurance plan to make sure that I'm protecting my assets in other ways. So as people go forward and start doing their planning for what they can do in terms of what their income is going to be into retirement, you then start taking a look at risk to my income in retirement. So we have a legacy plan, and a lot of times the legacy plan is what I would like to have my heirs receive. So as part of that whole legacy plan, you might have one of these policies. Now, we all know that if you can't spend a dollar twice.
Okay.
Although we have some federal governments and some governments who seem to think you can spend a dollar twice, but we all know you really can't spend a dollar twice. So the catch then comes into play. If I'm using, if I have a long-term care access rider on my life insurance and that's my legacy plan, does that mean if I use it for long-term care that I've diminished my legacy plan to my heirs? And the answer is yes, you have. However, if you talk with your heirs, most children, looking at their parents, would say, we want to make sure that you're as well taken care of as we possibly can. So these types of riders are riders that can make a lot of sense because it can pick up an expense that someone didn't see coming. So while I'd like to make sure my family has some sort of legacy plan, I'd also like to make sure that I'm taking care of myself as best I can. So with these types of coverages, in the event that I need the long-term care, while it may erode at my legacy plan, it's still going to allow me to maintain more independence in terms of going forward by being able to use that death benefit to cover some of the additional long-term care costs that I didn't see coming.
Okay.
So the long-term care riders, now, to make life, and no pun intended as we're talking about life insurance, to make it even more complicated, insurance companies have now come up with contracts that overweight towards long-term care. So now what these contracts are doing is they're basically saying, we are going to work towards providing true long-term care insurance on a life insurance chassis. So these are very different. So when you see these contracts, what you'll see is, and in many cases, they're a single premium product. You pay one premium, and what you're going to get is a large long-term care benefit, a smaller death benefit, and cash value.
Okay.
Now, those products are built on two different policy designs. So when we, as people get used to now, when you're talking about permanent life insurance, there really are two types of designs. There's the universal life model, and there's the whole life insurance model. When you look at the universal life insurance model of these hybrid plans, which are plans designed to really protect you as much as they can against long-term care needs, you're going to see a model that's going to have your premium, which will be most times, again, single premium. Some have, multiple premiums that can be paid in. I think the highest can be up to 10 years, but most people will look at these in a single premium option. I want to put in $25,000, $50,000, $100,000, put it in here, and here's the protection that I'm buying for the rest of my life. With the Universal Life program, what you will normally see is, here's your long-term care benefit that you've just purchased. It'll show you in a lump sum bucket amount what it is, and that amount will be drawn out or given to you in declared monthly benefits for a certain period of time. Also in there will be the cash value. Usually at about year 5 to 6, you will find out that the cash value gets back to your original premium. So if I put in $100,000, usually by year 5, I'll have my $100,000. Most contracts today on the Guaranteed Universal Life model will have that $100,000 be the same. You're not going to gain any growth on your cash.
Okay.
But you do have an exit strategy. If for some reason down the road somebody's changed their mind and says, hey, I no longer want to do this, I want my $100,000 or whatever I put in back, it's there and it can go back.
Typically without surrender charges by that time?
By year 5, yes.
Okay.
Typically by year 5, everything's clean, here you go.
Okay.
In addition to that, you'll have a death benefit. Now that death benefit will start lower than your long-term care benefit, and the death benefit with the universal life model will actually slowly decrease to a certain amount, and then it'll level.
Okay.
It will usually be greater than your cash value, but that death benefit will then be there. So that if you never use this for long-term care, your beneficiaries would receive back not only your premium, but a little bit more than your premium that you put in initially. Okay? So that's the universal life model, and it's kind of a once and done kind of deal. I've paid my one premium. This is my long-term care that I know I'm covered for. If I want out, here's my exit strategy. If I die without using it, here's my death benefit. The whole life insurance model is a little different. What it does is it takes the same single premium and it essentially says, here's your long-term care benefit, here's your life insurance benefit, and here's your cash value. And what's going to happen is all three of those are going to grow. Now, here's where I will tell you the major difference is. The difference between the whole life chassis and the universal life chassis is that in most cases, the universal life chassis will offer more long-term care benefit than the whole life chassis.
Okay.
Okay? It's going to be stated, it's going to be fixed, and it's going to be guaranteed. In the whole life insurance chassis, with the way they build those, is what you're going to see is all those columns, all that growth is going to be based on dividends. And dividends are not guaranteed.
Right.
Okay? I would say likely, but not guaranteed.
Right.
So as the cash value is growing and the long-term care benefits growing, so is your life insurance benefit. So all three columns are continuing to grow on the whole life insurance. I wouldn't say, and I don't say to clients that there is one that is better than the other. It's really what people are comfortable with, and that's really what this speaks to. There's no science, unfortunately, when making long-term care decisions about exactly what we should have. If we knew what long-term care we would need, we could plan for that very efficiently in a number of different ways, but we don't. So the guaranteed universal life contracts basically give you very focused benefits on your long-term care. That if you need long-term care for an extended period of time, that is the contract that will serve you very well. If you should need access to more cash value, if you should need long-term care for a shorter period of time, it's quite possible that in the end, the whole life insurance chassis could serve you better. But again, we don't know what the answer to that will be. What I find in working with clients is that when you show them the way these two models work for their particular situation, the client will start to get a feel for what makes them the most comfortable. And ultimately, that's the goal. Building something for the client for when they see how it works makes them the most comfortable. So those are your examples, if you will, of the way these permanent life insurance contracts are being built today to create even more living benefits. Now, I do see we have a little bit of time, so there's one other living benefit that I thought that's worth talking about as well, and that's actually an income benefit. One of the things that we talk about when everybody's talking about their planning is longevity risk. And longevity risk is kind of the risk I think we're all looking for. It's basically, I've lived so long and so healthy and I've been so active, we've spent a lot of our money doing a lot of wonderful things. But that now means that we're still active and we're older and we would like to be able to augment our income. Well, how can we do that? What can we do with our permanent life insurance policy that does that? And that's where the cash value in a whole life insurance contract or in another permanent contract becomes of paramount importance. In other words, what does it look like if I start using that contract for systematic income? And those are examples where clients can start to really see how their permanent life insurance policy can really not only touch their legacy plan, but can also touch and protect a healthy, long, active retirement.
Okay.
So those are some of the areas that we talk about when we talk about living benefits with the life insurance contracts.
They're interesting alternatives because we look at that when we first talk about life insurance, we're talking really about needs at death, and we don't know to go beyond that.
Right, and I think it's an important aspect too, because having flexibility in what we do in everything financial. I know one of the big things that I talk about with every financial plan is just like when you walk into a building, a good fire marshal will tell you when you walk in, figure out how you get out, right?
Right.
Well, with financial tools, it's always a good idea before you walk into that financial tool, how do I get out? In other words, when my money goes into that financial tool, what are the ways that I can access my money out? And do those create enough of a benefit to me that makes that tool attractive to me?
So the hybrid type of planning can plan for multiple needs, where some people will say, if I needed or came into some risks in retirement that were either unforeseen or difficult to project, that the life insurance policies can be designed to help insure your other retirement assets.
Correct, so that you can actually have a plan that has some flexibility that's inherent into your plan.
Okay. I did not know they were this flexible, actually.
Most don't.
Yeah. So that's interesting. What I also have found is when I'm looking at these types of thought process, where I'm combining needs into one product in this case, there's probably efficiency of scale, but the other issue is, let's say we needed $100,000 in life insurance, we decided, or $1 million in life insurance, but whatever our need was that we projected, it's established upon death, I want these funds available for my dependents or my heirs or my estate needs. And I don't want to use those up during life for other needs. Is it possible to combine those two and say, I would have bought a $300,000 long-term care policy and $1 million life insurance policy. Therefore, in this hybrid situation, I might buy a $1.3 million hybrid contract so that I'm not decreasing my estate protection with the life insurance and still able to tap a portion of the death benefit for those living needs without deteriorating my ulterior motive or my ultimate motive of having death benefits still existing.
Yes and no. In those types of situations, I normally recommend that you keep them separate.
Okay.
The reason being is that, first and foremost, the riders that allow that money to be accessed for long-term care cost money. So while you're paying for that value and it's an added piece of protection, you don't want to pay for that value and an added piece of protection on protection you never want to have used that way. So to separate that out would be more beneficial and cost efficient for the individual. So it might be the exact same looking plan, if you will, but just on two separate contracts.
Well, Ian, I appreciate it very much, and I'm sure all the viewers and listeners do too. If you have questions on this or other areas of estate and financial planning, give our office a call. I work closely with Ian. We can work with you together, help you design and tailor your own individual plans to suit your own personal needs. Thanks again for tuning in. Ian, I want to thank you again for coming back.
My pleasure.
And we'll be back again next week with another edition of All Things Financial.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.